I'm joined by Harsh Roongta, who is the founder of Fee Only Investment Advisors. Thank you so much, Harsh, for taking the time. And I want to start by asking you, I think, something that will lay the foundation for this conversation, which is that a lot of financial planners say that when you buy gold, you should look at it in two aspects, or you should divide it into two baskets. One where you're going to wear it and look good in it, hopefully, and the other where you're going to treat it as an investment. Should houses also, or residential real estate also, be divided into these two buckets?
Oh, absolutely, Alex. I completely believe in that theory, both for jewelry as well as for your own home. So, both a jewelry that you do self use has decent resale value, and I think a home that you stay in, typically for most middle class houses, tends to be a large uh, part of what they will invest in. It typically becomes the largest thing that most people will buy in their lifetimes. Uh, but it is not really an asset. Think back about it. In the Indian social milieu, how many times have you heard that whatever is a personal jewelry is sold, or whatever home you are staying on is sold and invested in another asset? It may be sold so that another home is bought. A jewelry may be exchanged for fresh jewelry, the one that is worn. So clearly, something that you're never going to use as an investment should not be counted as an investment. In fact, in our advisory practice, we just don't take either jewelry, which is personal, and the home as an asset at all. So it does not get into the asset allocation calculations. It just does not get in there. And this is something I completely believe in. And I think that's a correct treatment. The mistake people can make is treat it as an asset, because, that gives you a false sense of achievement. You might have, the house that you stay in might have appreciated, but so what? You're not really going to sell that and stay on the road.
Yeah, absolutely. And you couldn't have put it any better. You've written in the past, and I've come across an article of yours where you've said that buying an under construction property, which I think a lot of people do, considering the attractiveness of the price at that stage of the building of the property, is not really investing in real estate. Why do you say that?
So, I mean, really think about it. I think when you speak about real estate, and people just tend to think of under construction, because that's where the industry is focused towards. That's where the developers are. That's where, as per some very old statistics I had seen, about 62/3 of the residential properties bought during a year are under construction. Only 1/3 were ready to occupy or resale properties. So there is a large industry, large commercial involvement with it. The problem why I don't take it as real estate is, this is really you giving money to a developer, and you hope to God that at some point he will deliver a property to you. Sure, RERA has made things slightly better than what it was in the past. But I'm sure if data was available, and I think our earlier guest mentioned the fact that there is a flight to safety. Very clearly, the characteristic when it is under construction and when it is ready is very different. The reason under construction prices are low is because they are so risky. Like any other investment, return follows risk. So if you want high return, you have to take high risk, which is what an under construction property is. I have written, when you buy an under construction property, you're not investing in real estate. You are lending to a developer. And I think if people remember that, as long as people, there's nothing wrong in doing it, as long as people do it consciously. You're not buying real estate. I think as long as that is clear, there should not be an issue.
I think also, Mr. Rungta, that is changing because, like we were having in the previous conversation, there are a lot of people that are now moving towards buying completed projects. But that's a subject for a different day, I think. Let's talk about where you rank real estate as an investment. Uh, Again, you've written that there is a law of large numbers. So people get a little bit flummoxed by that and they think that they're making a lot of money, but the real rate of return that you get is not really very attractive. So, in terms of long term investment options, where do you rank real estate?
So I think it is like any other asset class. Any asset class needs to be looked at the three parameters: risk, return, liquidity. And when we are talking investments, so we are not talking your own home. We are talking investments other than your own home in a residential real estate. And we are talking ready real estate, residential estate. There, the risks are moderate. Okay, the returns are moderate as well. Liquidity is poor. So, I mean, if you have, but the issue with real estate investments, as we just defined it, is that it is lumpy. And which means that if your portfolio is small, if your investments are small, it will tend to hog it fully. And therefore, unless your portfolio or investable surplus is large, you cannot really look at real estate. Of course, things are going to change as we see more real estate mutual funds coming in. Rates become popular. Of course, rates more occupies the commercial real estate side rather than residential. And there, the lumpiness will go away. The liquidity will become much better. So I think after that, the equations might change. As of today, unless you have a very large portfolio, I don't think you can look at real estate as an investment. And as I repeat, I'm not talking about your own home. And if you do decide to have real estate, you should have a percentage, a 20 or a 30 percentage, not more than that. And that would be my prescription. The law of large numbers is very simple. What if I was to tell you that if you invest 1 crore today and 50 years later your grandchildren get 116 crores? Okay, what do you think is the return on this? The return on this is barely a double digit number. It's about 10%. Not a bad return, not a great return. Considering today's environment, uh, the point is, but people don't look at that. People look at the 116 times expansion. That's what I mean by the law of large numbers. When your initial investment is large, the ultimate realization obviously is large because it has compounded for a long time. So the illiquidity of the asset is not easily sellable, because of which you stay in that asset for a long time. So its disadvantage becomes an advantage. And because of that, what you get back is a large number. Percentage wise, you may not make a more than a moderate return, but it looks huge. This is where the real estate legend comes from. Invest in thousands, make in crores. If you delve deep into it, you will find that it has gone through 50 years or 60 years before the thousands became crores, and the return is just what I mentioned, moderate.
Absolutely. Absolutely. Closing words, Mr. Rungta, now with regard to the strategy that people employ. One popular strategy and the argument that is made is you rent property, and along that same time you save up, save for 8-10 years, so that you have a sizable chunk, and therefore you reduce your cost of acquisition of property. Now, I think this is quite a sensible thing to do, but an argument against that is being made by saying that interest rates are at historic lows and it's very attractive right now to buy property. So maybe you should just bring that acquisition forward. Where do you stand in this debate?
So I think you're talking of buying your own home and deferring it, and instead of investing the EMI into the repaying the loan, pay rent and the balance amount you invest in equity. I think that's what you are asking. And I would not really favor that, but for not for the reasons that you mentioned. Uh, I think the real cost of renting versus buying your own home, the real cost is social. The social norm is that success is measured by you staying in your own home. Of course, COVID has also sort of, as Mr. Gaurav was saying, it has sort of made that even more imperative. But very clearly, the cost of defying a social norm, when people feel you are completely unsuccessful if you're not staying in your own home, even though you might have taken a large loan for that and maybe struggling to repay the loan. I think the social cost of not owning your own home is very, very high. So your ability to continue with the behavior of investing in equity systematically, especially when equity goes through its normal downturn, which it will do every 3, 4, 5 years, because that is the way that cookie crumbles. It will go up again over long periods. You make excellent return, but because you are already paying the cost of not conforming to the social norm, and then top of that what you invested goes through a downturn, makes it a very difficult thing to continue to stick with. And I think it will be very, very few people who would manage to do that. So this goes against human instinct. So as far as buying your own home is concerned, I feel people should buy their own home when they have got a reasonable amount of surety about which city they're going to stay in. They have the ability to put in the down payment, and the loan amount is only such that it does not take away more than one third of their net take home income. I think once they are in that situation, they should buy their own home and not really go into these rent versus buy calculators, which completely does not take the social and the emotional cost of not owning into account.